So the U.S. housing market's basically frozen solid, but Home Depot somehow just beat earnings anyway. Welcome to Earnings Unscripted. It's August 18th, 2026, and we're looking at Q2 numbers for ticker HD. And Miro, they pulled in nearly $47.9 billion in revenue. That's up roughly 5.7% year over year, despite nobody moving houses.
Right, but you have to look at who's actually spending that money. It isn't the weekend DIY crowd buying paint anymore. The professional contractors and their newly acquired distribution channels are doing the heavy lifting here. But yeah, EPS came in at $4.79, which was comfortably above the street.
Which probably explains the wild ride on the tape this morning. The stock gapped up hard pre-market, looked like it was going to run, and then just faded all day to close completely flat. And since we're talking about stock moves, obviously this entire chat is strictly our own personal opinion and not actual financial advice. But I'm curious what caused that midday fade. Did traders catch on to something weird under the hood?
They always find the fine print eventually. Look, management gets credit for controlling what they can in a tough environment. But there's a massive, and I mean massive, artificial bump in these numbers. They recognized a $730 million tariff refund. That's a one-time government windfall hiding some serious underlying inflation in raw materials and fuel.
Okay, wait, back up. So if you pull that giant government check out of the math, they're actually hurting on supply costs, because I really need to know exactly how ugly that gross margin looks without the refund propping it up.
Well, the optics change completely. Out of that massive tariff refund we mentioned, roughly $685 million flowed directly through cost of goods sold. That juiced their gross margin by 145 basis points for the quarter.
Okay, so that completely papered over the cracks. What's dragging the underlying margin down then? Just expensive fuel and raw materials?
Partially, yeah. The CFO called out fuel and resins, but the real hidden anchors actually from their own strategic shift. Management cited 60 basis points of negative mix pressure, mostly coming from the recent acquisitions of SRS and GMS. They're pure B2B distribution businesses, supplying things like heavy roofing and steel framing.
Hold on. So they went out and bought these huge distributor brands to find growth, but the new assets actually dragged down their corporate profitability? That sounds like a terrible trade.
No, that's not quite right. The margin rate's lower, sure, because wholesale distribution naturally carries a lighter markup than selling individual power drills to retail shoppers. But the absolute dollar volume from those segments easily makes up for it. Without those acquisitions, they'd be drowning in this frozen housing market.
Oh, I see. So it's a conscious trade-off. They accept a slightly lower margin rate on those specific sales to capture massive bulk revenue from contractors.
Exactly. The do-it-yourself retail side's totally flatlining. Professional builders literally keep the entire ship afloat right now. Anne-Marie Campbell practically took a victory lap on the call. Quote, "We are winning with the pros. Pro-positive comp in the quarter, driven by the many investments we have made across our systems, capabilities for pros."
Okay, but how? If housing turnover is literally at historical lows, where's the demand actually coming from? Contractors don't just invent projects out of thin air.
True, they don't, but they aren't necessarily relying on more total projects happening out in the real world. They're just capturing a much bigger piece of the contractor's wallet for the projects that do exist. Have you looked at what they're doing with logistics lately?
You mean the express delivery thing?
Yeah, they just pushed it nationwide. Customers pay a flat fee, and Home Depot promises supplies to the job site in under 3 hours. Think about what that means for a plumber who suddenly realizes he lacks a part but doesn't want to leave the site. And management mentioned most of those express orders actually fulfill in less than 1 hour.
Wait, really? I mean, I get a pizza in an hour. Bringing heavy construction materials directly to a job site that fast sounds logistically impossible for a normal retailer.
They're cheating. Kind of. They aren't treating stores like a traditional retailer anymore. They launched this in-store B2B marketplace platform called Quote Center. So a contractor walks in, requests a massive custom order, an AI-powered AI-powered software automatically builds the material list. It mixes what's physically sitting on the store shelf with whatever's miles away in an SRS distribution warehouse, combining it into one drop.
So the local retail store just becomes a rapid staging ground for the master distributor network?
Spot on. They even rolled out an app called Magic Apron that pinpoints exact localized inventory based on the specific building the associate's standing in. That completely changes the speed of fulfillment.
That's wild. It builds this massive competitive mode. You've got physical speed combined with industrial scale.
And that's why they don't care about a little margin mix drag. They're trying to own the professional builder's entire life.
So if they lock down the contractor base now while the market's frozen, what happens next quarter when those temporary government tariff benefits finally vanish?
Well, that's exactly where the rubber meets the road. If those tariff dollars go away, they have to either absorb the raw material inflation or pass the pain directly to the pros. And right now, management expects those margin pressures to reappear pretty quickly in the third quarter.
Which is probably why Richard McPhail sounded a bit defensive today. They reaffirmed the full-year guide, right? So they still expect total sales to grow somewhere between 2.5 and 4.5%. But he heavily emphasized the unplanned costs.
Right. He basically said, quote, "With all of that, we are focused on controlling what we can control." They're modeling adjusted operating margins around 12.9% for the year. But to me, the real unknown isn't just the spreadsheet. It's the leadership bandwidth. Did you catch the note about Ted?
Yeah, I did. A sudden temporary medical leave for an executive. They kept it incredibly brief on the call. Obviously, you hope he's recovering, but strictly from a business perspective, losing a key operational guy while you're navigating inflation and digesting massive wholesale acquisitions is just really tough timing.
You've got a frozen housing market, vanishing tariff buffers, and a temporary vacuum in the C-suite. Basically, they have to execute perfectly on their integrations just to defend the guidance. They think gross margins end up roughly flat by the fourth quarter, but there isn't much margin for error left.
It's a massive bet on completely locking down the professional builder before the residential homeowner wakes back up. If they pull it off, they've structurally rewritten their entire moat. Until then, we'll just have to watch how well their pricing holds up next time around.
Always a pleasure. Catch you next time.
If you enjoyed hanging out today, go ahead and add the podcast to your lineup so you don't miss out. And to pull off our own version of express delivery, you should know this entire show, our voices included, is a fully synthetic AI project built to turn an earnings call into a finished episode the exact same day. We'd love to hear your thoughts or what tickers we should cover next. So shoot an email to earningsunscripted@datamadness.ca or just use the X link in the show notes.
Catch you all later.